Roughly 30% of the average viewer's portfolio may be sitting in SCHD, an ETF once hailed as the ultimate dividend machine. But something beneath the surface has begun to shift, quietly at first, then more forcefully, revealing a troubling pattern that could jeopardize the very foundation of long-term financial security. What was once considered the safest corner of the stock market is now showing signs of stress. And unless investors pay attention, they may not recognize the cracks until their portfolio has already suffered irreversible damage. The calm exterior of SCHD is beginning to fracture, and this shift demands scrutiny, not complacency. For years, SCHD attracted investors with its promise of predictable income, stable cash flow, and a disciplined selection of quality companies. It offered peace of mind while high-growth tech stocks swung wildly. That reputation led to widespread confidence, even dependence, but recent performance has diverged from expectations. While the broader S&P 500 remains comfortably in positive territory, SCHD has quietly slipped into a 2.5% decline. The source of this underperformance isn't just market noise. It reflects deeper structural issues that could worsen if left unchecked. The March 2025 rebalance was the first major red flag. Typically a routine reshuffling of holdings, this year's adjustment coincided with volatile headlines about tariffs and market instability. In the midst of that chaos, SCHD rotated out of defensive stalwarts and replaced them with unproven names at precisely the wrong moment. The result, a sharp 1.16% drop in just one quarter, while the S&P 500 fell only a fraction of that. A single poorly timed move transformed a defensive ETF into a liability, and the consequences were immediate. Further complicating matters, SCHD dramatically increased its exposure to energy, nearly doubling its allocation to oil and gas stocks from 12% to 21%. This overweight felt like a win while crude prices surged, but energy is notoriously volatile. As soon as oil cooled, that heavy allocation became a drag, pulling the fund lower and creating unnecessary risk in a portfolio designed for stability. At the same time, rising risk-free yields added another layer of pressure. With Treasury bills and money market funds offering 4 to 5% returns with zero volatility, institutional investors began rotating out of dividend-focused equity funds. Why accept equity risk when cash pays the same? The exodus of capital weighed on SCHD's share price, leaving everyday investors confused and exposed. Suddenly, the once attractive dividend yield didn't seem so special anymore, especially when compared to government-backed alternatives. The problem is not just performance, but perception. Many investors entered SCHD expecting safety, income, and consistency. But the world has changed, and the fund's methodology, while disciplined, now struggles against shifting macroeconomic forces. That realization can be unsettling. Consider a $50,000 investment made at the beginning of the year. Instead of steady returns, that position now sits on a paper loss. And while the dividend continues, its relative appeal has eroded. The feeling that something secure has become unstable is difficult to ignore. Still, context matters. SCHD has a strong historical track record, 388% total return since its launch in 2011, averaging 12.4% annually. Only 4 calendar years have ended negative, and its worst drawdown was just 5.5%. That pass lulled many into believing it was immune to downturns. But bulletproof is not the same as future-proof. What worked for the last decade may not thrive in the next. Today's environment forces the fund to chase yield in cyclical sectors and abandon previously favored positions, all while market volatility increases. So what comes next? The answer isn't panic, but preparation. Investors now face a choice. They can stay the course, accept more turbulence, and trust that the fund's screens will eventually recover their edge. They can explore high-yield alternatives like covered call ETFs, sacrificing some upside in exchange for enhanced income. Or they can tilt toward growth, leaning into tech or sector-specific funds while bracing for stronger swings in both directions. Each path carries risk, but doing nothing and hoping for the best is the riskiest option of all. Some have already started adjusting, building diversified strategies that blend growth, income, and ballast. Maintaining a core position in SCHD may still make sense, but only as part of a broader, more intentional allocation. Risk should be managed actively, not passively endured. And while this year's price decline may seem modest, only around 2.5%, the real story lies in the total return. When dividends are reinvested, the loss narrows to 1.4%. That extra percentage point, compounded over years, is not trivial. It's how professionals protect portfolios during turbulence. They don't react emotionally, they follow rules. Trim allocations when key levels are breached, scale back when momentum turns, re-enter when stability returns. The discipline of rebalancing isn't about timing perfection, it's about consistency and clarity. Ultimately, SCHD is not broken. It is being tested by shifting interest rates, sector volatility, and structural missteps. These conditions have created a perfect storm, but storms pass. The key is staying alert and ready to adjust. Because markets move in cycles: fear, correction, recovery, growth. SCHD, once the calm shoreline, is now the site of rising tides. The sand beneath is starting to shift, and those who wait too long to move may find themselves overwhelmed. That's why every investor should reflect tonight. How much of your financial future depends on this one fund? Is your allocation still aligned with your risk tolerance, your income needs, your goals? Don't wait until discomfort becomes disaster. Diversify with intent. Use the tools available: growth, income, safety, in proper measure. And above all, stay engaged. Portfolios don't crumble in one day. They erode in silence. The faint warning signs are already here. And whether they become an opportunity or a regret depends on what happens next. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.